Okay, we're gonna stay with it here and get right into it with the small cap growth panel. It's again, thank you. I see some new faces in the crowd, so I just want to welcome everyone. Again, if you weren't here for the last session, my name's Dave Judice, and I head up Intermediary Sales and National Accounts at Barron. I want to welcome everyone to the 29th Annual Barron Investment Conference. So I'm going to ask my colleagues on the small cap panel here to briefly introduce themselves, and then we'll get right into it.
Hi, I'm Laird Bieger, co-manager of Barron Discovery Fund.
David Goldsmith, I'm the Assistant Portfolio Manager of the Barron Small Cap Fund.
I'm Cliff Greenberg, the manager of the Barron Small Cap Fund.
Randy Gwirtzman, co-manager of Barron Discovery Fund.
Great. Okay, so you have guys in front of you who, looking at the small cap fund, have generated over 400 basis points of outperformance since inception, and Randy and Laird on the Discovery Fund over 500. So very impressive results, guys. We're looking forward to hearing from you. Cliff, maybe you could get us started, kind of this crazy market. How did we get here?
Yeah, let me try to simply explain what's taken place in the markets and the world year to date, just to kind of set a frame of where we're at. The year started off with interest rates spiking because inflation reports were starting to perk up late last year. The 10-year bond went from 1.5% at the beginning of the year to 2.5% at the end of the first quarter. Stocks sold off, especially small cap growth stocks sold off very significantly. And we weren't really unnerved at that point, basically thinking that the growth outlook for the economy and our companies was very much intact, and now stocks had sold to very cheap levels. In the second quarter, the inflation reports that came out continued to get worse and worse. And the long bond went from 2.5% in the first quarter up to 3.5%. And we started hearing from our companies that they were having some issues, meaning oil prices had spiked because of the war in Ukraine. The dollar started moving again, the dollar appreciated, which is bad for our company's earnings. And so stocks continued to act poorly in the second quarter, and the economic outlook at that point was kind of foggy. We weren't sure what was going to transpire. In the third quarter, which just ended, the market actually held in and had this very volatile move, because at first interest rates went down pretty significantly when people got concerned that the economy was slowing down and therefore interest rates would not continue to rise. And the market had a very, very big move. Our portfolios went up 20% or so early in the third quarter. But then later in the third quarter, basically, inflation reports continued to be bad, unemployment remained very low, and the Federal Reserve was very strident in that they had to increase interest rates very significantly and firmly to combat inflation. And the Fed has increased interest rates 75 basis points 4 months in a row starting in June. And whenever the Fed kind of has opened its mouth kind of saying it's going to increase rates, the market gets concerned that, and rightfully so, that the economy is going to slow significantly. The earnings of our companies are going to be lower or lower than they would have been, and that a potential recession or slowdown is in the offing. And so now we're in a period where it really does, we are hearing from our companies. We're in third quarter earnings right now. And our companies most of them are actually doing very well. Some of them are kind of saying they're seeing soft demand maybe in Europe, or some of them still have some idiosyncratic issues concerning COVID. But most of them are kind of bracing for a slowdown in growth go forward, and their earnings will be negatively affected by all of this. So it's been, that's really what's transpired behind and the backdrop to what's been kind of a miserable market and a very tough market for what we do, which is invest in growth, which has been out of favor, and invest in small caps, which are also out of favor.
Yeah, and the uncertainty caused by all these macro factors is really the biggest issue. People don't know exactly when the economy is going to turn or how deep the recession will be. We follow some indicators and that traditionally have pointed to the way to understanding when this is going to kind of bottom. Nobody knows exactly, but historically the indicators that we look at housing, purchasing managers index, things like that, indicate that maybe by the second quarter of next year, we'll have hit the bottom in these economic indicators, at which point the Fed is going to stop raising, will start easing potentially, and the markets will recover. What's particularly interesting is that small caps lead into recessions and they lead out of recessions. Right now, on a relative valuation basis, and we've got good charts in some of our literature that you can download on the site. Small cap growth is at historic lows versus large cap. It's a really interesting time, and we see it in our portfolio companies on individual valuations as well on every company. The last point I'll make is you just don't know when it's going to happen. It feels like a lot of the air has been taken out of the balloon. Maybe there's some more, but when the market recovers, it recovers hard, and there's only a few trading days that typically account, and this is in our literature as well. There's a few trading days that account for a huge amount of the incremental gain from the bottom. So if you're trying to time the market, if you're perfect, that's great. I want to hire you. But if you're not, it kind of pays to play the averages. And so what we're seeing from a fundamental, moving from the macro to the fundamentals, is our individual companies we're just so excited about. The businesses are solid, and we think that looking out, in our 3 to 5 year long-term investing time frame, there's a lot of juice in the lemon, and we're going to have terrific returns from here. So I'll turn it over to David.
So what are we doing about it? What we're doing is, what we do in a lot of these uncertain times is we're constantly interacting with our management teams and understanding the risks in the near-term business, but really focused on the long term. Less concerned if the earnings are going to be 10 or 15 cents here or there difference, but can they grow sustainably and maintain their competitive advantage? What we look for are these secular growers with sustainable competitive advantages. And if our thesis holds, while the near term is choppy and uncertain, the earnings powers of the businesses we invest in will make us a lot of money from here, especially where the prices are. So that's what we're trying to do, is stick to our knitting, stick to our process, and our competitive advantage versus others is our access to management. It helped us certainly during COVID, and I think it's certainly helping us now frame what the long-term opportunity in these businesses are. And we're excited about what we own, making sure that the 70 stocks in our portfolio, we really feel comfortable that are long-term winners.
Yeah, I would just add, the business cycle is natural. We see in these trough periods, what happens is that capital becomes very tight. Our companies, we typically invest in businesses that have well-funded business plans. Most of our companies are sitting with lots of cash on their balance sheet. And so what we're seeing is that in a lot of cases, either competition that would have come about had the business cycle not turned south is not coming about. And in many cases, competitors that had business plans coming into this are now running out of money, and it's going to make our businesses much more competitive coming out of this.
At that point, I think maybe open up for a couple of questions from the audience. Let's see, if you wouldn't mind, we have some mic runners that if you raise your hand, they'll come around. I see a question over here and over here. If we get the mic runners are coming down the aisle. And I'd ask if you just keep it short and sweet so we can try to get as many people as possible. We'll start with the two I see over here, please. Thanks.
The market sentiment has clearly turned against companies that are not profitable. Can you speak to how that may have affected the portfolio? Particularly curious about Baron Discovery and how you anticipate that will evolve in terms of what's popular and what's unpopular on Wall Street.
You want me to start, or you want to start?
Go ahead, Laird.
Let me make a couple points on that. First of all, you're absolutely right. If you think about what's performed the worst within our portfolio and small cap generally, it's companies that are losing money. There's a legitimate reason for that if you think about it, which is if you're a company that's losing money and you need to raise capital, trying to raise capital in a period where the market is down a lot is really, really hard. And so here's the good news, is that when we look at our companies, all our companies are funded to profitability. As I mentioned in my last point, we were talking about companies actually buying back stock now. They have so much cash on their balance sheet, and they raised it at much higher levels in many cases earlier, a couple years ago, and are able to buy back stock today even. And so we feel very good about where our companies are from that perspective. The second point I make is that we're seeing a lot of our peer funds, so if you're invested in other small cap growth funds, they're transitioning out of a lot of these companies. The worst performers are these ones that are down 50, 60, 70% that are losing money but have good balance sheets. And you're seeing a lot of our peers transition out of that into what, let's say, larger small cap companies that are generating positive free cash. And while that might be the right thing to do now, as a portfolio manager, the hardest thing is to do the uncomfortable thing. And the uncomfortable thing is to continue to slowly transition into these businesses that are losing money but have great growth prospects, great management teams, and we think are long-term winners, because when something's down 70%, well, that means it can also triple in value just to get back to where it was, or depending on how much we're talking. And it's as a portfolio manager, the way to outperform is to do what's not popular in what others aren't doing. And so Randy and I are really forcing ourselves to make sure that we're not exiting out of those companies if they have good balance sheets and great management teams and great long-term prospects.
I would just say one quick thing is Barron Discovery is less than a quarter of our companies are not profitable. But as Laird mentioned, they're all funded. So it's critical, and we don't have to worry about capital raises in a bad market.
Question here? Thank you.
Oh, hi. I like the previous panel's estimate of the equity price or stock price. You said the total return is kind of like dividend plus growth plus the valuation or PE, right? I didn't have a chance to ask that question, but I guess maybe everybody in Barron share the same philosophy, right? Growth is kind of tough, and dividends is fixed, and most people expect recession coming within the next six months. So what's in general you guys or Barron's expected return for the next 6 months or next year? With all that said, maybe we should hold off investing in the fund in the next 3 months with all these things coming. Also, in your model, in general, what is the cost equity that is embedded in the model? You can share it. Thank you.
So I guess we're long-term at Barron, so asking for a next 6 months view, you're probably not going to get.
But I think
let these guys. Yeah.
Maybe we can do this through an example, guys, and everyone chime in. But let's use a company that reported last night. Floor & Decor is an example. It's a hard surface, especially retailer. That business has grown, when they IPO'd, their same-store sales 10 years plus 10%. And in each market and in each box that they've opened has been very successful. They are taking hard surface flooring, vinyl, laminate, wood is taking share from carpet, and that concept is very hard to disintermediate via e-commerce. So this is a specialty retailer that has a long pathway of growth, has advantages in sourcing and in their breadth and wealth of product, and it's 30% cheaper than every other independent branch. So this is a great concept that is going to be struggling near term, because when do you redo your floors? Whether you're selling a house or you're buying a house, and existing homes are decreasing near term. So the near-term earnings, to your point, is very uncertain. We're debating internally if that's going to be $2.75, $3 next year, $3.50, and the stock is $65. We think, again, it matters, but less so is what's important is to us, what can that business do over time? They have 166 stores now. We think that'll be 400 to 500. Each box does $15 million when it starts, up and matures to 30 million a store. So we're talking about a business that, again, near term could do 250 of earnings to 3 to 350, not exactly sure, but over the long term, in the intermediate term, 3 or 4 or 5 years, that can earn $7 of earnings. And that $7 of earnings is worth 20, 25, 30 times earnings. And we're talking about a stock trading at 60 today because of the near-term uncertainty that we strongly believe has competitive advantages, will earn $7 of earnings be worth $140 to $200. Longer term, those 500 stores at maturity will do 15 billion of sales with a market cap of 7 billion. So the near term, it's very hard to suss out what those returns in that stock will be. We think the value, the stock is reflecting that uncertainty, but longer term, we really feel strongly that that's a category killer in that sector.
Just to help make the fine point, earnings are going to be softer next year than we would have thought they're going to be. We're uncertain what those earnings are going to be because we don't know how bad or if it's going to be a deep recession, a shallow recession, or no recession at all. So we have all different ranges of estimates. But for the most part, stocks are cheap, lower multiples, and they standardly trade at what we think they'll earn next year. They're super cheap against what we really strongly believe they will earn in time. In this case, we think earnings will probably triple from present levels, and the multiple will expand over time, and that leads us to a feeling that we'll make 3 or 4 times in our investment on this stock from these levels. So when will that play out? I mean, that's a pretty good return. We don't feel there's a lot of upside, not a lot of downside. Can we start making that money sooner than later? Do we need it? Do we need to get through the recession? Or do we need to have a clearer picture of what's going to happen before the market starts going up or reflects this? We don't really know. But kind of, as it was mentioned before, we don't think anybody really knows. And therefore, the right thing is to be in these companies that we have this strong conviction will be worth multiple fold of what they presently are now. And we'll make the money, and we'll make a lot of money when the market acts a little better.
Yeah, one last thing. I titled Randy in my last quarterly letter, "It's time, not timing, that matters in stock market returns." And that is 100% the case. We don't know when it's going to turn, as Cliff said, but I can tell you with a lot of confidence that given where things are trading today and how out of favor small cap growth is, when it does turn, we're going to make a lot of money. And psychology is going to switch at some point in the next 12 to 18 months where people are not saying, what is the downside and what is the down market going to look like? And they're going to say, what is the upside recovery going to look like? And when that happens, what you're going to see is that even if fundamentals continue to deteriorate, we're going to see stock prices going up against that because sentiment and psychology is starting to change, and it will change before fundamentals get better.
Okay, next question. Excuse me. We have one there, and we have one over here. Somebody with a mic.
Thank you. Cliff, in small caps, it seems like over the last few weeks, the FANG stocks have really deteriorated. Maybe not so much Apple, but all that money and all that money that's in ETFs that follows that seems to be making its way into small caps. Maybe I'm a little bit too optimistic, but I did seem to see it last week, not so much this week. What's your feeling there? And do you see the big turn from the long-term growth stocks into the small caps, which I think would be very good for all 4 of you?
Oh, I don't know. From your lips to God's ears. We have these moments where it feels like people are coming back to what we do and appreciating the Floor & Decors in our smaller companies, and then there's a next trading day where it doesn't feel like that's carrying through again. So, so I really, and the rotation out of technology. Technology companies are, and we own a lot of technology companies, not just FANG, but all sorts of software businesses. Those businesses are definitely slowing because their customers are uncertain at this moment and basically ordering less units right now or slightly delaying their purchases or expansion of their business, which is hurting tech stocks. But all our technology companies, we don't own those big FANG companies. Those are trade alongside or trade in sympathy with what's happening with the big companies. But like Floor & Decor, we have a lot of businesses that we think, are really fine companies that trade at very low multiples of what we think are depressed earnings and will be worth multiple fold as much over time. So is it next week that we start getting paid on this, or is it next month or next year? I wish I knew. I think it's worth hanging, though.
I would say small cap software. So, the large cap FANG companies that have been hit are more broad economic based and less specific than some of the companies we own, like cybersecurity companies and things like that. But the multiples that those companies are trading at now are historic lows from the last recessions that we've seen them through. So listen, next year, managements are nervous. They're being conservative with guidance. Customers are conservative with getting RFPs done. 23 is going to be like, a tough year. But everybody kind of knows that. The question is how tough. Once people figure out how tough, that's when it gets to what Laird's saying. And this thing's, the market's going to rebound. And these valuations, which are so cheap now, are going to be super compelling. So, we're just plugging away and hoping that things settle soon.
And small cap is 4% of the global market, the market cap. Historically, that's 7%. So if you do revert to the mean, you should see, as you are hopefully pointing out, that flows do come back. And like Randy said initially, small caps are historically cheap versus their own historical trading averages, as well as cheap versus large cap. So those both are working in that favor.
Right. First time they've traded at a discount to large cap since 01 or 02. So it's been 20 years. And so, in many ways, another data point to get you excited for medium-term investors about small cap growth.
Yeah, almost never happens.
Great. Okay, so there's a gentleman with a question over there.
Arnie Baby.
Hi, guys. Good morning.
Hi, Arnie.
Hey, Arnie.
IPOs have always been an important part of the success of Barron. Your access to companies on initial offerings. There have been virtually none this year. As you look towards 2023, do you expect that to be a tailwind for your small cap funds?
Yeah, I mean, Arnie, the questionnaire is one of our close friends and somebody we've done business with for a long time, and he's right in that we like investing in IPOs. So that for the uninitiated are companies that are doing their initial public offering new to the public markets. And we thrive on that because we get to visit with all these companies as they're going public, spend time with them, and we really feel like we are able to kind of get a good feel and get a sense or quickly come to grips with if this is a company that we're interested in investing in or not. And also, often those IPOs get priced at good valuations, and therefore for years and years we've stepped in or used IPOs as a way to find new ideas, where we see things before others, we can buy things at cheap prices, we can get to know the companies quickly and determine if we really want to make sizable investments out of them. And this year there really have been none, and therefore we haven't invested in any IPOs, and what that's meant is that for at least the small cap fund, the amount of new investments are usually 10 a year, 15 a year. We run very low turnover funds. We have a 70 stock portfolio. We hold these stocks for many, many years, the ones that we really believe in and are working. But we'll buy 10 new stocks a year. This year we bought 2 or 3 new stocks because there isn't that IPO funnel. When that comes back, which probably comes back next year, usually the best companies that come public, usually the way it works is that the first companies that come public through IPOs are the best companies because those are the ones people are more interested in purchasing. And they also will come public at cheaper multiples so that they can have a successful deal. And so the setup coming out of a slow IPO funnel into one that's starting again is great for us. You can find great merchandise at really cheap prices, and I imagine that will be a source of a lot of new ideas for our fund next year or the year after when the IPOs start.
And we're getting early access to these management teams. They do non-deal roadshows. We visit a lot of private companies as part of our due diligence. So we're kind of ahead of the curve, getting to know these management teams well before the IPO process starts. And it's a good way for us to get new ideas.
And we're just supplementing that, Arnie, with a lot of, our new idea list is longer than it's ever been, just because the market's pulled back, and I've been doing this for 16 years, Cliff longer than that, and these guys as well. We have a long Rolodex of companies that we've been in touch with or on our wish list that are now more in our range and excited about re-engaging with.
Sure.
I appreciate the commentary on floor and decor. I wondered if each team could maybe give 2 or 3 examples of other companies like Floor and Decor and kind of describe the story, what you like about it, where you see it going.
Cool.
You want me to go first?
Sure.
So, yeah, I'll pick a stock. I have so many. So Mercury Systems is a defense electronics supplier to the major primes. The company has gotten caught up a little bit with supply chain issues, particularly with microelectronics, which is affecting a lot of industries. As that starts to ease, they'll be able to deliver things. And as the defense budgets increase, that's a tailwind to them as well. Because of the delays in some of these equipment deliveries and getting a budget together, the stock's traded down. Right now, it's trading at less than 15 times next year's cash flow. I think it's trading at 8 times our cash flow for the 2027 year, and cash flow can grow 15 to 20%. So I think it's a double over the 5-year period, and it's gonna double cash flow over that period. That's just a quick example, and that's how we kind of, if you want a 50,000-foot view, that's how we look at a stock.
Here, we are large shareholders in a company called Red Rocks Resorts, which is the operator of locals casinos in Las Vegas. In Las Vegas, there's strip casinos, which we all visit, and then there's kind of off-strip casinos that kind of serve the local market. So people who live in Las Vegas, either working in the casinos or have moved there. And many might know that there's a huge influx of people coming to Las Vegas. It's a real growing market because it's a great place to live. Taxes are low, and immigrate. It's the fastest growing city in the country. So Red Rocks is a company that has basically is the leader in this industry. It's an industry very protected, meaning you need. It's hard to license or to cite a new casino because they're restricted by the local government as far as how many casinos there actually can be built. So Red Rocks presently now has 6 casinos, 6 major casinos. They're actually doing fantastically. During COVID, they shut 3 peripheral ones, were able to move operations move their revenues and their customers to their 6 big facilities. The margins of the facilities went up significantly because they're doing more business just in those 6. And the company is making more money than they ever have, even in a softer consumer economy. And what they've just announced now is that, we reported earnings this week, that business is terrific, no sign of slowdown. If anything, they're optimistic for further growth in their existing facilities. But what's so exciting, and the stock is super cheap. The stock's $40. They'll do $5 of free cash flow this year, so it's trading at 8 times cash flow. It trades at 9 times EBITDA, multiples much cheaper than it historically has traded and much cheaper than we think it should trade. The excitement, though, is that the company has 7 parcels around Las Vegas that they're building out, and they're building new casinos on. The first one is one called Durango. It opens next fall. The company is investing $750 million into that facility. They think they'll earn a 20% return, which is enormous for a real estate project. They're funding that $750 million with free cash flow that they're generating from their present business. And so we think the company's EBITDA or earnings will go up significantly. That's almost like a 20% increase to the profitability of the business. And then on top of that, over the next 5-7 years, there are 6 more projects that are going to flow in. And therefore, the way we look at it is after Durango opens and is running at full capacity and earning what we think it will, we think the proper value of the company is 80. It's trading at 40 right now. And then over time, when they build these 7 casinos, which will take 5 or 7 years, we think the profitability of the business will more than double. The company will be twice the size, and that the stock will be worth 150 or triple the value where it presently trades. So, again, it's a one-of-a-kind, special, best-in-class business, super cheap now on present earnings, doing really well. Maybe their profitability will be negatively affected if we go into a recession next year. Maybe it won't. They don't think it will, but who knows? But we're betting on that this company will be twice as big in time, and feel very strongly that it will, and the stock will be up multiple fold on that.
Appreciate that question. We love talking about stocks versus the macro, so thank you for that.
Yeah, and I think with that, with 10 seconds left, I think we're going to wrap it up. These guys will be in the lobby, so you can approach them for questions. They'll be around all day. And we want to really thank you guys for investing with us.
Yes, if you don't mind, Dave, I meant to say this when we came here. There's a lot of familiar faces and a lot of long-term investors in our fund. We appreciate your support. We're sorry we're living through this together this year, this terrible market and this rocky performance. We're here to work hard and try to do well, and I think you can hear that we're invested in what we think are really wonderful companies that will be worth much, much more in time. And therefore, we expect that the fund will get back on its foot. Our funds will do well as they kind of always have. So thank you very much.
Thank you, everybody.